right. Good evening, everybody. It's 4 p.m. Eastern, so we want to make sure to get started right away. Respect your time. Thank you, everybody, for joining us for the June session of Making Sense of the Markets with Chris Curlow and Team LWC. My name is Mitchell Shields. For anybody who hasn't met me yet, I'm the financial planner with the team, and I'm going to be moderating the session today. So the session today that Chris is going to be speaking on, we titled it, When There Is No Ceiling, the Sky is the Limit. I'm going to be talking on quite a few different events that have gone on relating to the market over the last month, and also spend some time on adjustments we've been making to client portfolios and some potential opportunities that we see in the market right now. The session should run probably right around 15, 20 minutes. We'll leave some time for questions at the end as well. So I'll be watching the question section. If you have any questions, please fire them in. We'll make sure we address them at the end. And without further ado, I'll pass things over to Chris.
Thanks, Mitchell. So our title this month alludes to the U.S. debt ceiling that we've just recently overcome. Obviously, in the United States, won't be an issue again until the 2025 election. And so now the question is the sky the limit for the markets, or are we in for a rocky ride? May was another challenging month for the TSX, down 5%, giving back much of the gains. A little bit lower again here today on our broader index. The S&P 500 in May was flat as well. The NASDAQ again soared 6% on some of that trade resolution, debt ceiling resolvement. However, we'll get into kind of that NASDAQ a little bit later, but it really does spur on the back of the breadth in the market. That lack of breadth is being highlighted here in the chart on the bottom right. You can see that the equal weighted index of the S&P 500 is basically flat since the Silicon Valley Bank, SVB, blow up, with the market cap weighted index rising almost 10%. That really is coming from a ton of gains in your FANGMAN stocks. That's Facebook, Amazon, Netflix, Google, Microsoft, Apple, and NVIDIA. Fortunately for a lot of you clients out there, we do own a ton of NVIDIA in our Team LWC US top picks portfolio. We have been paring that back, buying into some other names. We'll get into some of that later on in the discussion. As mentioned earlier, maybe I haven't mentioned it yet, just in my pre-recording practice, but the Bank of Canada raised rates again today. Surprise hike, took the TSX back a little bit. Wasn't an overly huge surprise to us. Inflation still has been running hot. The labor market, broadly speaking, remains robust. We saw in the U.S. 339,000 jobs in May, much higher than what the analysts were expecting. It's actually the 14th month in a row analysts have underestimated that jobs number, and the strongest gain since June. On a positive note, I suppose, the quit rate in the United States is now back nearly to those December 2019 pre-COVID levels. Quit rate's a good indication of what people are actually thinking versus kind of a backward-looking jobs added approach that comes from lag data. Typically, you're quitting your job for the prospects of a higher paying job in the future. Tends to be an inflationary measure, so that coming down is positive for that future inflation data. These rate hikes that we saw from the Bank of Canada and possibly again here in the United States on June 14th, that number's up to about a 31% chance that we see a rate hike in the June meeting. The full intention of this is to slow inflation, but saying that another way is actually slowing economic growth, the labor market, and generally speaking, demand. All of that combined with what we've seen from this debt limit being raised, student loan repayments starting on August 30th is really going to pull back spending, particularly in that upper middle class discretionary items. Doesn't bode overly well for the economy. But the point, that we like to continue to reiterate is that the market is in the economy. It tends to be a forward-looking indicator. We'll talk about some of those opportunities we see being presented a little bit later on. But I want to pivot into a bit of an underwhelming restart on the Chinese economy, something that we had high hopes for. You're seeing manufacturing as well as contracted developments both coming lower. We've seen the crude oil and copper prices trending lower, usually a sign of industrial demand. China really comes off the back of that industrial demand. Another big aspect for them is the U.S. consumer. Chart on the bottom right is showing you that We are expecting little to no growth on those retail sales numbers. And Jamie Dimon said it pretty well during his recent JP Morgan Global China Summit. America's open for business, but Chinese companies are a little bit concerned about that. Increasing kind of on that geopolitical side, China's banned the sale of Micron chips. Saw some new news come out from Byte about the TikTok parent there in China on kind of increased regulation on data privacy concerns with what they're sharing with the Chinese government. And shipping container production out of China is down 71%. Again, a forward-looking indicator, because that kind of is an indication of the expected demand for those containers used in China. And then prices falling on all things stateside on the durable goods sector. Again, that inventory replenishment likely doesn't come behind it. Not great for the Chinese economy. So something we're watching closely, and the ramification that has for not only the domestic economy, but as well as their international trading partners. Housing had cooled earlier this year and the back half of last year on higher mortgage rates, but picked up in a meaningful way in April. We saw home sales jump 11%. We get kind of that April data at the start of June, just a little bit delayed in our data aggregation. A lot of that came from detached homes here in Toronto, as well as in Vancouver. Condos are moving up, but not quite at the same pace. Mortgage interest payments have risen broadly across the board. Canada has a much different market than the United States. We have max 5-year terms there. There they have 30-year fixed mortgages. Only 3% or so are actually on their adjustable 3 to 5 year rate mortgages. So a little bit more insulated stateside. This could certainly prove, and it's already proving to kind of be a headwind for the Canadian economy, impacting consumers' discretionary spending. But housing prices are holding in. So that seems to be a bit of a dichotomy between those two forces. And will we see that break at some point? Will Mitchell be able to get that big house in Oakville? We're hoping maybe at some point those prices ease, kind of helps that inflation. That's rolling into the rent side as well. Rents continue to rise. Affordability challenges remain on the fence, as well as the fact that immigration into our country continues to, provide larger demand for the housing market. In the United States, we've seen only a 2.1% increase year over year in housing prices. Still not bad, but comes off a major 20% bounce last year. So another topic that we'd be getting some questions on and thought we'd talk about a little bit this month and share some insights on the Canadian housing market. And obviously that has impacts on our financial services in the term of mortgages, which is a big part of our Canadian lenders, the big 5 banks, of which we obviously own a couple. And then the ramifications that has into the discretionary sector. We'll talk about a bit of that in our portfolio changes that came through in some questions. So like I alluded to a little bit earlier, the market is a forward-looking instrument. A lot of these things we've been talking to you about over the past several months, they're quite apparent to us. Although it looks like we are moving into a recession, arguably could already be in the midst of a recession. Some stocks are trading at recessionary type valuations. A good example are the telcos. We actually just added to that space right now. Telecommunications, we added to TELUS this month, is obviously one of the big 3 providers here in Canada. Your phone bill is one of the last, if not the last thing a lot of people are cutting. So very defensive, recessionary type of industry. Paring back on our consumer discretionary areas of the market in favor of some of those more defenses. We talked about the utilities last month. Again, longer duration asset, as bond yields have kind of come to probably near the top of the range that we're looking at. As they come lower, those longer duration assets like utilities tend to trend higher. Technology is also one of those, and part of the reason why we've seen a large move in the US tech space, rallying over 33% year to date. Reason they're longer duration is a lot of those profits that they're going to make are out into the future. Mitchell and I were talking previous to the meeting about the new headset being launched by Apple. The adoption and the profits from that are several years into the future. And then Jensen Huang, the CEO of NVIDIA, is talking about, the potential and the total addressable market of the metaverse, virtual and augmented reality. Again, all these opportunities aren't here today and do go into the future. And that kind of leads us to believe that, this has the ingredients of the making of another bubble, something I followed very closely earlier in my career during the cannabis craze. Then following that was the cryptocurrency. We're kind of seeing very similar signs. These bubbles often have common ingredients, access to easy money, the use of leverage. Right now, really, AI or tech is really the only space where you're able to get easy access to capital. Increased regulation. You saw that with cannabis, crypto. Now there's debate amongst the use of artificial intelligence, a mismatch between supply and demand, a lot more hype flooding the market with technology that may be a little bit ahead of its time, the global reach of the subject matter, and then broad market speculation. We think we're, nearing that phase of this cycle, and would be weary. As mentioned, we've been paring back our position in NVIDIA. Fortunate to have it, but it's just gone so far in the last, since we purchased it in October. I believe it's almost up 400%. It's a bit of a large move for $1 trillion organization to get there. And then one of the questions that I'll probably be talking about tomorrow on BNN at 10 a.m. Feel free to dial in if you have the ability, or it'll be available on their website following, is where does the market go from here? Does it go higher or lower? I would argue, the market is a question where I would say the potential's probably lower because of this bubble that we've gotten. But if you are a stock picker, I think it's a fantastic opportunity to buy names that haven't rallied with this. We talked about telecom. And what I want to highlight here is this chart on the bottom left. Less than 30% of stocks are outperforming the index. That's what alpha means. So although the index in the United States has rallied, the NASDAQ was up 6% and over 20 year to date. A lot of it's concentrated in that top sector, leaving a lot of orphan kind of stocks behind. I think there's a lot of protection there. I'm showing the S&P 500 price to book value for the banking sector, kind of down near those recessionary levels. Kind of buying low and selling high has proven to be one of the best strategies in investing over the course of time. And we think that a lot of these stocks are trading, probably justifiably so, that we are in this period of challenging economic period. But we are looking past that chasm and really think and get excited as investors as we look at these opportunities to move into these names at these levels. Another area, and why I highlighted this again, we've had a lot of discussions around adding to our position to the Japanese index, continued to rally last month up to a 30-year positive compound annual growth rate after being negative for such a long period of time. Everyone talks about kind of the lost decade in Japan. But unlike Canada, and why we continue to like outside of North American opportunities, is the fact that in Japan, you have, mild inflation versus what we're seeing here domestically that allows the Bank of Japan to remain accommodative, super low interest rates domestically. Share buybacks are at a 16-year high, super great for shareholders, and the index as it is. The price to EBITDA, massive discount to what we see here, despite the fact that the index there is very similar to the Dow Jones Industrial Average. And then you're seeing actually expansion in both the services PMI as well as the manufacturing PMI. And last month, we talked about the lack of resumption in the Chinese tourism to Japan, which formerly was a massive part of their tourism bubble. You can see that on the chart in the top left, just 11% of pre-COVID levels is kind of getting picked up by both the United States and South Korea, trending much higher than what they were experiencing in December 2019. Shout out to my summer student, Howie, for putting that one together. That's some pretty cool data, Howie.